Good afternoon, it's me again. I thought I'd give you another update on what's been happening this week and just take you through a few slides from some things that I think have been quite interesting and just give a bit more insight into what has happened and what I potentially think could happen going forward. So without further ado, I want to share my screen here and show you some of the slides I have been looking at. Here we go. Okay, so this is my update today. Yeah, so this is an interesting slide which shows how this correction is comparing to the previous four corrections. What you'll see is that this one is much more dramatic, so it's come down really, really quickly. So if you look at the dot-com bust, for example, that took 4 or 5 months to come down to the full bottom. Again, financial crisis was along with me. It took almost 6 to 9 months to reach the bottom. But with this, it's dropped very, very, very quickly. That indicates to me that given that we've hit it so quickly, I think potentially we could come out of it quicker than we have other crises. But that's to see what happens on that one. And this is an interesting slide, which basically shows the history of the FTSE 100. So this is going back to 1984, and it shows that of the 36 years that it's been going, 27 of them have been positive. 9 of them have been negative. So it shows that long-term investing, you've got 3 times more likely to get a positive year than a negative year when you're investing in the FTSE. Also, when you do have a drawdown, the typical drawdown is about 14%, as that shows there. And every single year there is some sort of drawdown. There's never been a year where it's completely gone one-way traffic for the FTSE. So the biggest drop we've seen there is 30%, 39%. And obviously the smallest drop is, smallest drawdown in a year was 2019. That was actually quite an interesting year. It was only down 1% at its worst. So quite interesting. But I hope that gives you some reassurance that investing over the long term, you're 4 times more likely to get a positive year than a negative year. It looks like this year is panning out to be one of the negative years, but yeah, let's just wait and see on that one. Because this is quite an unusual situation, what's happened with COVID-19, hasn't really been very much to compare going back over the years. But the only thing we have got is the SARS outbreak back in 2003, and that was pretty much specific to Asia and more in particular Hong Kong. But what you can see here is as the number of cases spiked, the market continues to drop. And then very quickly after the number of cases peaked and got over that high point, the market rallied very quickly and very strongly, actually above to where it was before the market. So I'm not saying we're going to get an exact replica of that. I think COVID-19 is much more dramatic, with economies shutting down entirely, which is going to be brand new for the market to deal with. So, but what I do think is once we get over the hump of the number of cases and we should get a reasonably quick recovery. That's what I feel could happen. I think I've spoken to a few of you about this slide before. This basically shows that the market rises regardless of the news flow, so basically the market climbs a wall of worry. So this is going back to 1985. There's always been unbelievable amounts of negative news flow and things that you maybe think, oh, well, I can't invest at this time because of swine flu, SARS outbreak, bond massacre, the collapse of Baring, long-term cap, all these things. You think, well, I'm not going to invest because that's definitely going to have a negative impact on the market. Now, these things do have negative impacts on the market, but I think from this slide you can see that upward trend is there. So a lot of people do hold back and think, well, I'm going to wait till everything's right and then there's no bad news. That's when I'll invest in the stock market. I mean, this slide shows point blank that is not the way to do it. The way to do it is get in early and get in long term, and that the stock market does rise again, almost regardless of the news flow, but it does climb a wall of worry. And what I'm very conscious of, back in 2008, there was a huge amount of people who didn't invest and they just sat on cash, and the market rose and rose and rose. and they missed out on this last 10-year bull market. So I think we might not get that on this recovery. This is a chance for people that have missed out on that last 10 years to get in. Yeah, and this slide to me I think is very interesting, because it basically shows that if you sit on cash, people think cash, there's no risk in cash, but there is a huge risk in cash. You're basically sitting, your money is losing value every single year, guaranteed against inflation. So we all know that although the actual balance of the bank is the same, if you have put £100,000 in the bank now, came back in 12 months' time, it would still be £100,000. But you and I know that in a year's time, that will only buy maybe 2 or 3% less bags of crisps than you could have bought now, and that's inflation. The long-term effect of inflation on £100,000 or any sum of money is dramatic. So if you had £100,000 in cash in your bank account in 1985 and completely left it, then the actual monetary value of that in real terms is equivalent of £32,561. So it's very interesting. Remember, if you're sitting on cash, it may be good short term, but long term, absolute disaster. And you've really got to look for alternatives. That stat alone almost encourages you or sort of pushes you towards some sort of investment. No, it doesn't have to be full stock market risk. It can be something different, but sitting in cash for the long term is really, really ugly and not the thing to do. Yeah, and this brings a bit of hope, or just a bit of numbers to what the experience of investing is like. And it's basically saying if you invest on a 3-month basis, there's a 30% chance that you will be down over 3 months. If you invest on a year basis, in the FTSE 100, then there's a 23% chance of you losing money over that period. But basically, it shows the longer you're in the market or the longer you're invested, the less and less likely are to lose money. So there's plenty of 17 of 3-year periods. You got 17% chance of losing money if you're investing for 3 years. That drops to 11% chance if you're investing for 5 years. Really, that drops almost dramatically down to 1% if you're invested for a time period of seven years or more. There's been very, very few 10-year periods where cash has outperformed the stock market, and there has been no 15-year periods when cash has outperformed the stock market. So if you want to guarantee yourself to make money in the stock market, I mean, the statistics would say invest for 15 years, and that's one of the things I always ask is how long people are investing. How long have you got as your time horizon for these investments? The longer you've got, the more chance you've got of that being positive when you do come to draw on it. So that's that. Yeah, and there's just a few more things about the bear market and what history teaches us. Key things to stay calm, don't panic, and don't make short-term decisions. Don't let your emotions get ahead of you. You know, your emotions are the enemy in a bear market. You haven't lost any money unless you sold when your portfolio drops. So the key thing is don't sell out. Don't crystallize your loss and let somebody else get all your gain when the market recovers. I've mentioned last week about the best days are often very close to the worst days. This has been exactly the same situation here. We had, with the market rallying 15% in 2 days, 2 or 3 days last week, which was, quite astonishing. But it just shows you it's very, very key that you stay invested in these difficult times when your market has dropped. Remember the reasons you are invested in the first place. Most people are invested for the long term for their pensions, and although this is difficult and it's wobbly at the moment, it shouldn't affect your timescale, and we should have a good recovery by the time you come to retire. As the charts I've showed you here, shares show that they're a good return of money in the long term. Bear markets, as the first slide shows, bear markets are typically a lot shorter than bull markets. The fact that your portfolio is diversified means you're not taking the full downside. Then you're ready to compound upwards from a higher level when the markets recover. So if you are getting too stressed about it, don't watch too much social media or telly. But the good thing is at the moment the the markets are slightly out the news. It's more about the horrific number of cases and the impact of that. But that's my update for this week, and I hope everybody is well and coping okay with self-isolation. So any questions, please let me know. You'll be able to get me anytime. Thank you.